name is Iris Franz, and today I'm going to talk about cost of production. In particular, I want to talk about the difference between explicit and implicit costs. So in the textbook, you can see the definition of explicit cost will be the monetary payments, and the definition of implicit cost will be the opportunity cost of using your own resources when you're producing goods and services. Now, instead of trying to memorize the definition from the textbook, I want you to use your intuition. So when you see the word explicit costs, then there will be something that you can see from the accounting book. And you can actually see the money being deducted from your bank account, or you can see your business credit card being charged. Then there will be explicit costs. And by contrast, implicit costs are the costs you cannot see from your accounting book. So I'm going to give you an example. Suppose you're operating your own restaurant after you graduated. And in order to operate the restaurant, because you don't have your own restaurant space, so you have to rent it. And because of that, you have to pay for rent. And of course, you have to pay for insurance. And you also have to buy, say, lettuce, tomatoes in order to make a sandwich. So that food will also cost money. And you can actually see the money being deducted from your bank account or from your business credit card. So that will be explicit cost. So suppose the amount to $28,000 explicit cost. Now, what about the implicit costs? So remember, you just graduated, right? Suppose you graduate from the Cameron School of Business, and because you major in economics, you have taken a lot of econ classes and acquired a lot of analytical skills. So you already got a job offer from a consulting firm. They hire you and they promise you a salary $70,000. Now, in order to operate your own restaurant, you will have to give up that salary. So that will be your opportunity cost of operating that restaurant. So that will be the foregone salary, and that's implicit cost. You can see that you do not see $70,000 being deducted from your bank account. And you don't see your credit card being charged $70,000. You don't see that from your accounting book. So that will be your implicit cost because you don't see it from your accounting book. And suppose you also save up $100,000, and because you want to operate your own restaurant, you cannot leave the $100,000 in the bank to earn the interest anymore. You invest the $100,000 in your restaurant, and therefore you have to give up the interest payment from the bank. Now, suppose the interest you can receive from the bank, say it's 1%, then your foregone interest will be equal to $100,000 times 1%, that will be $1,000. So instead of earning the $1,000 interest, you don't earn that interest from the bank anymore. You invest your $100,000 in your restaurant. So your, say, implicit costs sum up to $70,000 plus $1,000, that gives you $71,000. Now we're going to calculate our profit. So there are two kinds of profit: accounting profit and economic profit. So accounting profit is equal to your total revenue minus explicit costs, whereas economic profit is equal to revenue minus explicit costs minus implicit costs. So graphically, suppose this block is your total revenue. Now, what is our accounting profit? So that will be total revenue minus explicit cost, that block, that will give you accounting profit. Now, suppose our total revenue is $100,000, and we already know that our explicit cost is $28,000. So your accounting profit is equal to $100,000 minus $28,000. That gives you $72,000 accounting profit. Now, what about economic profit? That will be equal to total revenue minus explicit cost, $28,000, minus implicit cost, we just calculate that. That's $71,000. So $100,000 minus explicit cost, $28,000, minus implicit cost, $71,000. That gives you $1,000 economic profit. So you can see that economic profit is always going to be smaller than accounting profit. Why? Because your implicit cost is never zero. Nobody's opportunity cost is ever zero. So your economic profit will be lower than accounting profit. And that tells you it is possible that we have a positive accounting profit but negative economic profit. That's totally possible if your implicit cost becomes really big. And notice that for entrepreneur, implicit cost is just as important as implicit cost. Because at one point, if your implicit cost is too high, meaning your opportunity cost becomes too high, you might decide, I don't want to operate my restaurant anymore. So I hope this helps to explain the difference between implicit cost and explicit cost. Notice that in your tests, a lot of tests, they're going to tell you a certain company, the revenue is so and so, and there are several costs. You will be told the rent is so much, and foregone interest, foregone salary, foregone rent, whatever is so much. What is accounting profit and what is economic profit? Now remember, think about whether you can see the cost in the accounting book or not. If you can actually see the money being deducted from your bank account, you can see the cost in the accounting book, then that means the cost is explicit cost, and you can use that to calculate accounting profit. But if it's a cost that you cannot see from your accounting book, say it's your opportunity cost or foregone rent, foregone salary, foregone interest, you don't see that money being deducted from your bank account, then that will be implicit cost. And you subtract both implicit cost and explicit cost from your total revenue, then you will get your economic profit. I hope this helps. Thanks for watching and see you next time.